battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past almost 44 years now, the Stenger family has made it our mission to deliver both clarity and confidence to help secure your financial future. Thank you for coming back to the show each and every week. It means so much to us that you take the time out each and every time to join us on the podcast and the YouTube show. And if you happen to be listening on Apple or Spotify, hit subscribe. Please don't forget, do it right now. If you're watching on YouTube, we would so appreciate you going on and hitting the subscribe button as well if you're watching there on YouTube. And that helps get the show to more and more people. If you want to get the clarity and confidence, the good news out to more and more people, your family and friends, you got to subscribe, got to share the show with your friends and family. So we so appreciate you coming back each and every week. We are also coming up very quickly now to some big-time events. If you don't mind throwing those up on the screen there. April 25th and 26th in Houston. We're going to be at the Four Seasons Hotel for a Wealth Insights Forum. If you're thinking about doing business with the Stenger family, if you thought about opening up a starter account, if you want to meet the group, or if you're a client, you got to get to this thing. I will warn you, it's already 76 or 77% full. And we've sent out 2 emails, and we're still about 2 months out. So if you were thinking about coming to this thing, this is one of your last chances. Get registered for it. It will fill up. We always send out a final invite here in the next week or so, and then it will be full. So if you've been thinking about it, little bonus tip for you, go sign up right now. Go to StengerFamilyOffice.com or reach out to Katie Poulos, our resident Greek here at Stenger Family Office. She will get you signed up, and you can't miss that. And then we're going to follow that up in October. So October 9th and 10th, we're going to be up here in the Chicagoland area. We actually bumped it up 1 month so that you might want to come in and join us. It's not going to be that cold. October is actually a pretty nice month, I would say, right, Producer O? Oh, yeah. Up here in Chicago, October 9th and 10th, we've got 3 guest speakers, not 2, like the usual amount. We have 3 guest speakers, and we will announce those very shortly, probably next week sometime. So get those events on the calendar. Don't forget to subscribe to the show. We're going to jump in episode 177, my crystal ball prediction. And let not your heart be troubled. You haven't seen the crystal ball in a little bit. Well, here it is. It is really heavy. Got it straight from Amazon.com. Thank you, Jeff Bezos. This thing has been our best friend. And you've been asking yourself, Nick, how do you guys figure out what to do with the stock market and the portfolio? And how have you been right on the money here for so long? Well, it's really simple. You just look into the crystal ball, rub your hands on it a little bit, and it just tells you. It tells you what the S&P is going to do. No, it's not that simple. We wish it was. But the reality is as we look out and we say, what's going to happen with markets the rest of 2025? What's going to happen in 26? What's going to happen after that? Everybody wants to know, first of all, is the stock market overvalued? Are we in a bubble? We did a show a couple weeks ago. I said the stock market's not a bubble. I still don't think it's a bubble, and we'll talk about why that is. But everybody is also asking, or not everybody, but we're starting to get more and more questions now of, Nick, given all the different changes with tariffs and potential changes with regulation, is this a market top? Am I buying in at the all-time record high? Well, the answer is yes, you are. You're buying in at 6150 or whatever the S&P is at today, and that is an all-time high. But when the S&P was 5,000 points, we still told you to buy, and that was an all-time high. And when it was 4,700 points in 2021, that was an all-time high. We said to buy. And in the short term, if you go back to 2021, if you paid 4,700 points for the S&P, you actually probably paid too much in the short term. The stock market corrected. 2022, we had a 20% correction. But all you had to do was hang on and have some patience, because 2023, the market came ripping back, melt your face off year. Thank goodness you stayed on your plan and you didn't have a panic attack and jump off. Like a couple of our people, I won't name any names, but we did have 2 or 3 that jumped off their plan. Thank goodness the rest of you stayed on, because then 2024 was a melt your face off record year. And then here we are again, 2025, S&P is up 4 or 5% again for the year. And so what stocks do over time is they climb this wall of worry, all the doom and gloom, all the negativity, all the noise, all the nonsense. The companies get past it. Why? Because companies in Wall Street are valued And Wall Street is valuing those companies based off of one metric. That's earnings. It's just earnings. What are companies doing in profit? Are they growing their earnings over time? If they don't grow their earnings, if they don't have good balance sheets, if they don't have rising revenues even, you are going to see the stock price go down. In the long run, though, the market is a weighing mechanism, just like Ben Graham, Warren Buffett's mentor, said. In the short term, it's a voting machine. In the long run, the market's a weighing machine. It's weighing the merits of a company. And so if you're buying good companies and you understand the business model and you understand why the company has a competitive advantage, for example, you're going to do just fine over time. Now, you could find the best company on earth. You could overpay for its profits. And that's the other side of the equation, is it's not just earnings in a vacuum. It's earnings times price. What are those profits worth next year, the year after? In accounting, it's just the going concern. If you've ever taken Accounting 101, you remember the going concern is the company viable over time. So the answer is the biggest and best companies on Wall Street, I think, are very viable. And I'm not going to make any recommendations here, so don't hear this as individual stock advice. But I'm going to tell you, I watched a video recently on Amazon Warehouse, and it's on YouTube, free for anybody to watch. If you haven't watched it yet, just Google Amazon Warehouse Robot, and it's absolutely incredible the way that these Amazon warehouses work. You watch this video, and you'll say, I'm never, ever, ever selling my Amazon stock. You'd be absolutely insane once you see what's going on behind the scenes. And so it's easy to get lost in the sauce. It's easy to get nervous in the service, as my grandpa Jack used to say. But when it's all said and done, when you get past the media doom and gloom and all the noise and all the nonsense and all the panic trading and selling, you're going to come in and be able to buy when stocks are cheap. So is the S&P overvalued at 6150? I don't think so. I think over time, over the next 18, 24 months, you're going to be happy you got into the market. I think stocks will be up. That doesn't mean we're not going to have a correction. So here's my crystal ball prediction, and I'm going to walk back through history through a few different decades, all the way back to the 1950s. And not that the past is a guarantee of what's to come. We know that past performance is no guarantee of the future, but to use history as a guide to get an idea of where we could be going, I want to talk about the basics. I mentioned this last week of how inflation started. It's all M2 money supply. It's the government printing money. So if you track one metric that comes out from the federal government and you just want to sift through all the noise and all the nonsense and just get to one core data point, you're going to look at M2 money supply. M2 money is all the money floating around in our pocketbooks, in our bank accounts, money market funds, all the rest of it. Well, in the 1950s, we increased money supply about 37%. Inflation, as a result, as Milton Friedman said, is always and everywhere a monetary phenomenon. So if you increase the money supply, what do you have? You have too many dollars chasing too few goods. Inflation went up 26% in the 1950s. So it didn't pick up the full 37% of money supply increase, but it did pick up about 26%. Not too bad. In the 50s, we had average inflation of 2.4% on an annualized basis. The 3-month T-bill, no surprise, was 2.1%. That's like a money market fund, essentially. The 10-year Treasury, decent spread, pretty tight spreads in the 50s. We had 3.5% 10-year average Treasury yield. But during that time, the S&P went up 243%. So if you held U.S. equities in the 50s, you had one of the best decades, actually one of the top 4 decades we've ever had. The 2020s, it's still the jury's still out. Got about 6 more years here before we'll see what happens. But the 50s were an incredible time to be in the markets. 1960s, M2 increased 95%, almost 3 times more than it did in the 50s. And what was that? That was LBJ. That was the big society, the Great Society. Print and spend, increase the size of government. Inflation, surprisingly, only went up 31%. And so what we're going to talk about is why it takes some time, why there's sometimes a lag on inflation from M2 money supply in a second. But during the actual 1960s, so 1960 to 1970, we had inflation of about 2.7% per year. We had a 10-year Treasury at 5.7. S&P went up 74% in the 60s. Then you hit the 70s. And all of a sudden, all the inflation that should have been coming in the 60s, you started to get a little bit more roll from the Great Society, from the bad policies that were coming in. And M2 money supply increased 155% to increase the size of government. 155% increase in the dollars floating around in the economy. No surprise, inflation went up 101% in the 10 years that started in 1970. Average inflation per year was 7.5%. So if you think things are bad today, which they're not great, they're worse than they were 5 or 10 years ago from an inflationary standpoint, it was nothing compared to the 70s. We were at 7.5% inflation per year. The average 3-month T bill was 8.9%. So just keeping your money in cash paid you almost 9% per year. The 10-year treasury was paying 9.4. And so you'll remember people who had maybe your parents, maybe your grandparents, maybe even you, depending on how old you are. You may remember having a 19 or 20% mortgage. Absolutely insane. And you would have thought that the market fell apart. It didn't. The market went up 71% during the 1970s. Not as good as the 50s at 243%, but still pretty darn good return. Then you hit the 1980s. Ronald Reagan comes in. Paul Volcker is fighting inflation at the Fed. Shockingly, M2 continued to increase 102% over the course of the 80s. But inflation only picked up about 63% of that. So we were able to drop the inflation rate during the 1980s to 4.9% per year. Here's what's crazy. Paul Volcker, to fight that inflation, raised yields to about 10%. And yields are so tight on the 10-year, a 10-year treasury would have paid you 10.1% in 1980. You would have thought the world would have came to an end. You would have thought stocks would have bottomed and markets would have fell apart. Not the case. 1980s, we posted a 225% return in the S&P. Why is that? I think it was good policy. I think it was just deregulation, better tax situation, more innovation, more entrepreneurship. And we're going to get to that at the end of today's show. But then you had the 1990s. And during the 1990s, what were the 90s all about? It was all about tech. It was all about innovation. We only had a 51% increase in money supply. Remember, Bill Clinton had to work with a Republican Congress and passed tax reform and a little bit of deregulation. Inflation only went up 2.9% a year in the 90s. The 10-year was still at 7.1%. Here's what the S&P 500 did in the 90s. It went up 390%, one of the most insane decades of all time. And so when people point to the 90s and say, we're going to end up in a bubble, Nick, isn't this just 1999? Aren't we in a bubble just like we were in the 90s? Of course, there was a bubble in 1999 and 2000, but the years leading up to 1999 and 2000, those 4, 5, 6, 7 years leading up to that, were absolutely incredible years. And so to try and time this out, to try and just get in and get out and figure out when stocks are overvalued and try and come back in when they're undervalued on every single company is a losing strategy. Instead, what you would want to do is just keep your money in the market in 1990, ride it all the way out through 2000 and 2005 and 2010. But those 10 years in the 90s, S&P went up 390%, one of the best decades ever. Then we all know about the 2000s. We call it the lost decade. M2 increased 80%. The Federal Reserve printing press picked back up, but inflation went up 28%, about 2.5% per year. And so this started the era of low inflation. From the 2000s, the 2010s, and now the 2020s, just finally now starting to pick back up with inflation. We've had sub 3% inflation for almost 30 years in this country prior to 2020. So in the 2000s, the Fed kept rates, in my opinion, way too high. You only had 2.5% inflation. They kept rates around 4.6% on average. It should have been much lower. And so what happened is the economy really stagnated in the 2000s. The S&P went up a total of 6%, not per year, a total of 6% for the entire decade. And so my point is even when you have these major issues with inflation or these major problems with money supply, don't panic, because to me, the worst case scenario of the S&P is you get a flat return. It's not usually typical that the bottom falls out for 3, 4, 5, 10 years at a time. Rather, what happens is you go away from the 200 or 300% return over 10 years and you just don't get much of a return at all. But here's what you have to remember. That's just the S&P, where it was heavily concentrated in tech in 1999 and 2000. But if you were buying value stocks, if you were buying dividend payers in the 2000s and you weren't paying too much for stocks, similar to what we're doing today in the Stenger Family Office portfolios, you actually did pretty well. And during that time frame, 2000 to 2010, Stenger Family Office clients did just fine. And so that's what you have to remember. It's not that the bottom falls out necessarily. It's just what price are you paying for stocks. That's why you have to be careful of what you're owning. If you're just buying the entire S&P, yeah, you're buying some companies today, just like you were in 1999, that are tremendously overvalued. I won't name any names, but I could pick out 10, 15, 20 names in the top 100 of the S&P, and I'd say be careful there. Those stocks are tremendously overvalued. But when you pull those out of the index, you're paying maybe 18, 17, 18, 19 times earnings. That's not 1999. We're not paying 44 times like we were in the tech bubble. So then we get to the 2000s and things start to get ramped back up. M2 goes up 82%. Nothing really that different from the 2000s. We had 08 and 09 with the recession. Inflation only went up 20% in the 2010s, 1.8% per year. The T-bill was 0.1%. The Fed kept interest rates artificially low, the opposite of what they did in the 2000s, where they had the 10-year way too high, the overnight lending rate too high. Part of what happened in the 2010s until 2020 in particular is despite COVID, you still had a 250% total increase in the S&P 500. You got back to some of those insane good years like we had in the 80s. Well, why is that? Well, part of that's just the base effect coming out of 08 and 09. You were buying the S&P for really, really incredible value. Some of these companies were trading at 10 times earnings. So you got to remember, there was a point in time over the past 15 years where you could have bought Apple for 10 times earnings. Well, you can't do that anymore. You're not paying 10 times earnings for Apple. So a lot of that was just valuation driven. We kept telling you during the 2010s, we said just buy, 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 buy. These stocks are just incredible, incredible values. And that's what happened. So here's the 2020s, and here's where we're at. So far since 2020, this now includes COVID, we've increased money supply by 38%, which is very, very high. Inflation's gone up 23% for an average of 4.3% per year. We have not had this inflation since the 1980s. But the average T-bill is still only at about 3% is the average. I know it's higher now. It's about 4.1, 4.2%, but the average is only 2.9. So the Fed has lagged on raising interest rates, and the 10-year has only averaged out at 3.1. So the bottom has not fallen out because stocks are still a reasonable value. The valuations, and I've been pounding the table on this for the past 4 or 5 years now, if you watch the show, is stocks are not overvalued. They're not expensive. If you're paying 18, 19, 20 times earnings, who knows? Maybe we go down to 18 or 17 in the short term, but it's not paying 44 times. And so over the past 5 years now, the S&P has gone up 91%. And if you sat that out, if you just said, stocks are overvalued, I can't get in, I'll wait till there's a big correction, you've literally missed out on one of the best set of 5 years almost now that we've ever had. And I would continue to argue today that we're going to continue to see that kind of growth. We may not see 300% like we saw in the 90s, and quite frankly, we shouldn't, because that would mean that valuations are going up. But I think if earnings continue to chug along here just fine, and we go up 10% a year, 12% a year, I think you're going to look back and you're going to have a very similar decade to the 1980s. Yes, we're going to have higher inflation. We're going to be in that 4% range. I don't think that's coming down overnight. But again, I've talked about this on the show the past couple episodes. You don't have to like the person in the Oval Office, but what they're talking about today from a policy standpoint is very, very, very favorable for equities. We're talking about getting the size of government lower. We're talking about lowering the amount of regulations. We're talking about cutting taxes, or at least keeping them low like they are today. And if you do all those things, you essentially are using the Reagan playbook from the 1980s. And I think if you watch what happens with equities now, the next 4, 5, 6 years, I think you're going to be pleasantly surprised that earnings growth will be better than expected. So as I look into the crystal ball, and this is what I'll leave you with today, I'm going to give you 8 points of where I think we're going. Number one, I think Trump is going to cut taxes and regulation. I think Doge is going to help shrink the size of the federal government. We're now projecting $1 billion a day in savings of fraud, abuse, and waste. Number two, I think that good fiscal policy is going to now lead to record S&P 500 profits that you never thought were possible. Best analysts on Wall Street are projecting 320 now for 2026. Which multiplied by 21 is about 6,700 points on the S&P, about 8 to 9% higher than where it trades today. Because of that, number three, the S&P, I believe, is still fairly valued, not overvalued. It's not completely undervalued either. It's not a massive, massive value like it was in 2010 or 11 or 12, but it's not overvalued. I don't think long term you're going to get hurt buying stocks at 20 to 21 times forward earnings. Number four, inflation is a lot more stubborn than people realize. Why? A lot of wealthy people are sitting on stockpiles of cash. They're spending like there's no tomorrow. If you don't believe me, just look at Ferrari. Ferrari just sold a record number of cars at an average price of $550,000 a car. If you think the top 1 or 10% are slowing down, they're not. That's inflationary. But by the way, it's good for the rest of the economy. So you should want that to continue. Number five, I think federal funds rate is going to basically stay where it's at. I think you're going to wake up about a year from today. You're not going to see a ton of movement on interest rates. But number six, I think the 10-year is going to price in no recession, thanks to good fiscal policy. And you could, this is a more crystal ball, far out prediction now. I think you could see the 10-year rise to possibly 6 or 6.5%. So be careful with long-term bonds. I think you got to be really, really careful here. Number seven, I think markets are going to have a panic attack in the short run if the 10-year spikes that high. And we're probably not looking at a 20% correction. That's usually only going to happen in a recessionary environment or a pre-recessionary environment is really how it works. I think rather what you're going to see is maybe 10% or 15%. That's very common. We have a 10% correction every 2 years. Statistically, we had one in 2024. We didn't have, or I'm sorry, we had one in 2023, didn't have one in 2024. So I think you're probably looking at one in 2025. If we correct 10%, this is a significant buying opportunity. But remember, you can't time this thing out because we may be correcting already from 6,500 points or 6,700 points on the S&P. And so a 10 or 15% correction makes the S&P undervalued or a really good buy at 57 or 5,800 points. Well, if you're in it today at 6,000 or 6,100, you have no business trying to time this. You're already in. Why would you try and get in and get out? So rather what you do is ride it up. You're going to have a correction. You know it's coming. And if you got a little more cash at that point, put it to work. But there's no sense in trying to time this thing. And so in the end, this is my last point, number 8, I believe all these things added together are going to produce equity returns of 10 to 12% as far as the eye can see. And this is not radically different than what we've seen the past 200 years. If you read Dr. Siegel's Stocks for the Long Run, he says 200 years of market history, S&P 500, 10% a year. So I would stay on your plan. Do not panic. Don't jump ship here. Don't try and get fancy and time this thing out and figure out when to buy and sell and try and be right twice and get back in. It's just not going to work. It's not possible to do that consistently over time. And if it were, you'd know a bunch of really rich people who started with 500 grand and now have 10 million because they traded the market successfully. I mean, how many of those people do you know? I don't know that many, And so I think instead, we know a lot of people, our clients, many of you, quite frankly, who have just stayed on your plan for 10 years or 20 years or 30 years or 40 years of a career. And you're looking back now sitting on a couple $1 million and you did it by not having a panic attack. So that's my encouragement to you. Stay on your plan. Don't worry. We're going to get through any correction we have. And I think when we get out the other side of it, we're going to trade the S&P at record all-time highs. Thanks for being with us. This was episode 177. We'll see you next time. Episode 178. Don't forget to subscribe on YouTube, Apple, and Spotify. We'll see you next time.